All right, let's get to it. Got time for stop trading from Jim.
I wanted to be able to bottom fish soon was Boeing. Morgan Stanley goes 235 down to 180. Production is slowing. The stock is getting hit. I wish I had something positive to say. But
it's just time that maybe I'm due an apology for all the crap you gave me for getting you out of Boeing.
Coincidentally, that's why I did this at the end of the show. I want Belle to know that David's mother. But I am apologizing. You got me out. I missed that 100-point move. But anyway, Boeing is still too early.
But it does go back, Jim. The reason, of course, I'm referring to is the conversation we had some time ago where you were talking yet again about all the pain, all the difficult things of Boeing, and yet you hadn't chosen to sell the stock.
But now you were right, and I got out. I didn't make money, but I got out.
Boeing Co., an aerospace titan, long revered as a bastion of innovation and engineering prowess, is currently navigating turbulent skies, both operationally and within its stock market performance. The recent decision by Wells Fargo to downgrade Boeing shares to underweight marks a significant shift in financial sentiment, as detailed by analyst Matthew Akers, who expresses skepticism about the future upside of the company's stock. This bearish stance is notable, given that it comes from one of the only 3 analysts out of over 30 tracked by Bloomberg to adopt a sell-equivalent rating on Boeing. As a result, Boeing shares plummeted by 8.3%, hitting their lowest intraday level since November 2022, with a year-to-date tumble of 33% as of the last Friday before the announcement. Akers pointed to several pressing concerns that precipitated the downgrade. Primary among these is the projection that Boeing's free cash flow per share is expected to peak by 2027, tempered by rising aircraft development costs that could outstrip gains from increased production. Further compounding this financial strain, Akers anticipates the need for a substantial equity raise in the forthcoming years, which could lead to further dilution of shareholder value. He also cites ongoing challenges such as union negotiations and a potential softening in airline demand, which may impose additional pressures on Boeing's operational performance. The backdrop to this financial turmoil is a series of manufacturing and ethical missteps that have marred Boeing's reputation over recent years. Most notably, the aerospace manufacturer has been grappling with the fallout from 2 catastrophic 737 MAX crashes in 2018 and 2019, which collectively claimed 346 lives and led to a worldwide grounding of the fleet. These tragedies not only led to a reevaluation of Boeing's aircraft design and manufacturing practices, but also exposed flaws in its regulatory compliance, culminating in Boeing pleading guilty to charges of misleading safety regulators. In the wake of these crises, Boeing has been striving to rebuild trust and overhaul its operational protocols. Promises of enhancing training for new hires, slowing production to ensure quality, and minimizing out-of-sequence work before planes leave the factory have been central to Boeing's strategy to mend its tarnished image. The recent appointment of Kelly Ortberg as CEO, who has pledged a commitment to true cultural change within the company, is seen as a step towards recalibrating the corporate ethos. Ortberg's vision emphasizes empowering employees to voice concerns about potential issues, a pivot towards transparency and accountability that he hopes will steer the company back to its former esteem. However, sentiments on the factory floor suggest a disconnect between executive promises and the daily realities faced by Boeing workers. Patrick Boone, a machinist at Boeing's Everett Delivery Center, expressed disillusionment with the company's direction. Once lauded for its robust support and recognition of its workforce, Boeing now faces criticism for eroding employee benefits, such as pensions, and for a perceived decline in workplace morale and operational efficiency. Boone's observations are echoed by other employees who report a pervasive sense of being overmanaged yet undersupported, a sentiment that has been growing since the operational disruptions caused by the pandemic. The workforce challenges are compounded by a significant loss of institutional knowledge following extensive layoffs and retirements, particularly during the downturn caused by the COVID-19 pandemic and the 737 MAX grounding. The current hiring spree, while replenishing numbers, has not sufficed to bridge the gap in experiential knowledge that defined Boeing's craftsmanship. This generational disconnect is seen as a risk to the quality and safety of aircraft production, an aspect that Boeing is urgently addressing through enhanced training programs and a reinvigorated focus on foundational skills. As Boeing looks to navigate these challenges, the broader implications for the aerospace industry and its stakeholders are profound. Investors, employees, and industry watchers are closely monitoring Boeing's strategic decisions, keenly aware that the company's ability to weather this storm will not only affect its future trajectory, but also have broader repercussions for global aviation safety and manufacturing standards. In summary, Boeing finds itself at a critical juncture where financial pressures, workforce dynamics, and the lingering shadows of past missteps converge. How the company addresses these intertwined challenges will determine its path forward in a competitive and ever-evolving aerospace sector. The recent stock downgrade by Wells Fargo may be a bellwether for deeper structural issues that need addressing, issues that Boeing must navigate with both caution and clear direction to restore its standing and ensure its continued success in the skies.